Assalamu alaikum. My name is Muhammad Affan Asif. This video is about the accounting for ICOM Part 1 students. This is the third video of chapter number 1, Introduction to Accounting. In this video I will tell you about some topics, which is what is an accounting convention, the transaction, classification of transaction, rules for determining cash or credit transaction, features of transaction. Now move to the first topic. Topic number 1, what is an accounting convention? Accounting conventions are guidelines used to help companies determine how to record certain business transactions that have not yet been fully addressed by accounting standards. Accounting convention is divided in the three parts. Number 1 is conservation. Playing it safe is both an accounting principle and convention. It tells accountant to err on the side of caution when providing estimate for assets and liabilities. First, I will tell you about assets. Things that are resources owned by a company and which have future economic value that can be measured and can be expressed in dollars. Then I will tell you about liabilities. A liability is something a person or company owes. Usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Which is consistency. A company should apply the same accounting principle across different accounting cycles. Once it chooses a method, it is urged to stick with it in the future unless it has a good reason to do otherwise without the convention. Investors' ability to compare and assess how the company performs from one period to the next is made much more challenging. Now move to the third point. The third point is materiality. Materiality refers to the impact of an omission or misstatement of information in a company's financial statements on the users of those statements. If it is probable that users of the financial statement would have altered their action if the information had not been omitted or misstated, then the item is considered to the material. If users would not have altered their action, then the omission of misstatement is said to be immaterial. Now move to the topic, which is the transaction. A transaction is an agreement between a buyer and a seller to exchange goods, services, or financial instruments. Accurate accounting records transactions when revenues or expenses are realized or incurred, while cash accounting record transaction when the business actually spends or receives money. Topic number 3, classification of transaction. Classification of transaction is divided into 4 types. Number 1 is cash transaction. A cash transaction is a business transaction that involve exchange of cash at the time of occurrence of the transaction itself. Cash in the case implies settlement. The settlement may be in actual cash by credit or debit cards, check payment or bank transfer, but would still qualify as a cash transaction if they are settled at the time of occurrence of the transaction itself. Now we move to the second point. Transaction. A credit transaction is a business transaction which, although have monetary impact, does not involve exchange of cash at the time of occurrence of the transaction, but is settled in cash at a subsequent date. Now we move to the third point, internal transaction. An internal transaction is a business transaction which does not involve any outside organization or third party. An internal transaction does not involve two parties. The fourth point is external transaction. An external transaction is a business transaction which takes place between the business and an outside third party, and external transaction therefore involves two or more parties. Example shows on the right hand side. The topic number 4 is rules for determining cash or credit transaction. There are the 4 rules for determining cash or credit transaction. Number 1 is all transactions in which the word paid is mentioned are termed as cash transaction. Example, rent paid, salaries paid, etc. Number 2 is all transactions in which the word cash or check are used are termed as cash transaction. Example, cash received or check received. The third point is all transactions in which the word on credit or on account are mentioned are termed as credit transaction. Example, bought goods on credit account. And the last point is if a transaction involves the name of a person or firm without maintaining the word cash, then it will be a credit transaction. Example, sold good to John for Pakistani rupees 5,000. This is the last topic of this presentation, which is topic number 5, features of transaction. There are many features of transaction, such as number 1, there must be two parties. No transaction is possible without two parties, just as it takes two hands to clap. So it takes two parties for a transaction to take place. There cannot be a giver unless there is a receiver. Suppose X borrows 10,000 from a bank. This is a transaction since there are two parties here, X and bank. Now we move to the second point, which is the event must be measurable in terms of money. An event will not be regarded as a transaction unless it is capable of being measured in terms of money. The third point is the event must result in transfer of property or service. Suppose we buy a motor car from S 40,000. This results in transfer of property from S to use, so it is a transaction. Again, suppose we pay salary to our employee 2000. This result in transfer of service. The employee renders services and we receive it, so it is a transaction. Number 4 point is the event must change the financial position of the business. Transaction takes place only when there is a change in the financial position of the business. The change in financial position may be of two kinds, which is on other slide. Number 1 is quantitative change. This change the total value of assets and liabilities of our business concern. Suppose machinery of 50,000 is destroyed. This reduces the total value of the assets of the business. As a result, the financial position changes and hence it is a transaction. Number 2 is qualitative change. This causes increases or decreases in the different elements of assets or liabilities, but the value of total assets and total liabilities remains unchanged. Suppose we buy machinery worth 50,000. This result in exchange of property cash 50,000 goes out of our position, and at the same time machinery of an equal value comes into our position. This does not change the total value of our assets, but this causes a qualitative change in our financial position. Hence, it is a transaction. Thank you for watching my video. Please do subscribe, share with your friends and family member. Allah Hafiz.